Hi, I'm Harper with Life with Leverage, and we coach people on the infinite banking concept and how you can become your own banker. We'll help you set up your policies and your systems and see if this strategy is a good fit with your goals and your objectives. Today, we're going to talk about how policy loans work. Now, when we talk about policy loans, we're talking about the ability to leverage or borrow against the cash value within your life insurance contract, specifically a whole life insurance policy designed with a mutual insurance company. There is something called cash value within your life insurance contract, or your cash or your equity, that you can access. We are able to actually withdraw that cash from the policy, but the preferred method is to leverage against the cash in the form of a loan. That loan in the insurance world is called a policy loan. The reason we prefer to do this is our cash within the policy keeps compounding uninterrupted, tax-free, and is not touched and lets that just snowball for the rest of our lives. When it comes to borrowing, though, there's a few different ways we can borrow. You can borrow directly from the insurance company. So say the insurance company, you have the policy with them, they will loan you up to approximately 90 to 100% of your cash value, depending on the company and how it's structured, in a policy loan, which is treated just like a line of credit. You also could use a third party, like say Bank of America, would actually loan against your cash value by taking what's called a collateral assignment, and you can assign the rights for them to loan against the cash value. And since it's such a safe place for cash to be stored, they also will loan up to 90 to 100% in the form of a line of credit. The con to that is that that bank would be more in control of that line of credit versus if you take a policy loan, you're going to be more in control how it's contractually written, and that's what we really want about becoming your own banker. And what Nelson Nash talks about in his book, Becoming Your Own Banker, is having more of the control. Now, if you borrow from an insurance company, a mutual insurance company, at the end of the day, that insurance company is going to give you so much contractual control, so to speak, and there's no middleman that needs to profit because you are actually part owner of the mutual company. There's no stockholders. You're one of the part owners. They don't have a middleman where they're going to have to mark up that interest rate. So right now, in the fall of 2024, you can borrow anywhere from 4% to mid 5% interest rate when market with a bank is 7 or 8%. Now let's get into it. We can loan up to 95%. That's a popular question I get approximately with the companies we work with. When you do take a loan against your insurance cash value, you're going to just have interest only. You got to choose how and when that policy loan's repaid, but we got to think of ourselves as a bank, and if we make a loan and don't repay it, how long will we be in business? So that interest rate or interest that is due on your anniversary, which is when you start your policy each year. So say it was June 15th, then June 15th next year, that's your anniversary when you pay your premium, have your annual review, etc. We want to at least pay the interest then so it doesn't compound on itself. And then we could just keep using our proceeds in an investment or financing a car or whatever we use it for. And if you want to repay principal or set up monthly repayments, you can, but completely up to your discretion on how and when you want to structure that. Fully your control, which is awesome. Now, in the insurance world, you're going to have a fixed interest rate or a variable interest rate, depending on the company you're working with. Some companies actually offer both. Like one of the companies we work with offers a fixed and a variable rate with one of the products we use, or whole life product. And fixed also could be defined as direct recognition, and variable could be defined as non-direct recognition. What that means is if you have a fixed rate guaranteed for the life of the contract, that when you do loan against the cash value, they're going to recognize that as in direct recognition that you took that loan. So let's say you had $100,000 in cash value. You could loan up to $95,000 approximately. Let's say you just loan $50,000. At the end of the year, when a dividend is credited on your policy, you're going to have half that dividend be slightly reduced in return for them offering you that fixed interest rate. But sometimes it makes sense to still take a fixed interest rate, especially in the beginning years of a policy before it starts maturing. Then there's also a variable interest rate, and that variable interest rate will float with the market, but still it's low fives approximately in the fall of 2024, when market's probably 7-8%, maybe a little bit higher for this type of line of credit outside of the policy, which is awesome to be able to have the wealth building ability to save the interest there a couple percentage points. Do policy loans show up on my credit report? These are private contracts, so you don't have anything affiliated with your credit. Doesn't show up in your credit report, doesn't show up with the bank. But when you do borrow against it, how long does it take to get the funds? Every company is a little bit different. Typically, it's a handful of business days for you to be able to get your policy loan proceeds into your bank account. Now, how do you do it? You could have your agent, you could talk directly to the insurance company, but what we like to do at Life with Leverage, reach out to our service team. You say, hey, I want to take a loan for X amount, or hey, how much loan do I want to take? How much do I have? We'll send you a DocuSign. You sign off on it. Boom, done. Funds hit your account in a handful of business days. Sometimes might take 5 to 7. Right now, it's taking a handful of business days. And at the end of the day, we're trying to make it as easy as we possibly can for you to get the proceeds, to use it in that investment or whatever else you're wanting to finance. And when you want to repay, you let us know what you want to repay, or if you want to start a monthly repayment or whatever strategy you want to go about repaying that loan. Awesome. Your money is still compounding in the policy and is never removed when we're leveraging against it. And becoming your own banker, like when Nelson's talking about it, repaying that loan, let's say the insurance company is charging you 5%. He might say, hey, let's charge ourselves what the market rate is, which would be 8% approximately. And you would say, okay, where's that extra 3% go? Well, the first 5% is going to go to the insurance company because you're borrowing their proceeds. And then your cash is still earning interest within the policy. Okay, awesome. But the extra 3%, hey, where's that going? That goes back to your policy by either accelerating your policy loan payback and therefore recapturing more interest yourself, or that extra 3% could go straight to buying more paid up additional insurance or paid up additional rider to get more cash within your policy at the end of the year that could compound with interest and dividends. So I hope this video helps. I'm happy to go into more detail with you one-on-one if you reach out. You go to our website, lifewithleverage.com, or you could email me at harper@lifewithleverage.com. Looking forward to talking with you.